FTX has collapsed, but what can you and I learn? That's today's episode. Hello and welcome to the Peter Billigus channel, where we sometimes make finance fun. At the time of this filming, the cryptocurrency exchange FTX has just collapsed and its founder and CEO, Sam Bankman-Fried, has been arrested. But even before the trial, even before all the evidence comes out, there are already things that you and I can learn from this situation. Even if you don't own any cryptocurrency, even if you don't understand what it is and how it works, there are fundamental financial lessons that we can extract from the collapse of FTX. Here, I think, are four of the most important. Number one, if you don't understand it, don't buy it. I know a lot of people who have invested in cryptocurrency, and they have a basic understanding of how it works. But when I dig a little deeper, they can't really explain what's going on. How is it protected from fraud? Is it regulated? Is it insured? If something goes wrong, who do you call? Now, I'm not knocking cryptocurrency. This advice is true with any investment. If you don't understand Microsoft, don't buy Microsoft. If you don't understand rental real estate, don't buy a rental property. And if you do want to invest in something that you don't understand, well, take the time to learn about it. Take the time to ask basic questions like, how do I make money off this thing? How could I lose money? What could go wrong? If something does go wrong, is there any insurance that I could or should purchase in advance? Who, if anyone, regulates this investment? What fees are associated with this investment? If I do decide to buy this investment, what is the smallest amount of money that I can invest to get started? These are just some basic questions to ask before purchasing a new investment. But if you don't ask them, or if you don't like the answers when you do, it's okay to not buy. It's okay if it appears that everyone around you is making a fortune and you're the only one sitting on the sidelines. Well, some of the most successful investors in the world have made their fortunes by watching and waiting on the sidelines for years. They kept building up their cash, and then when the market plummeted, they bought in. Some folks did this once. They just waited and waited and waited, and then they bought big when things were terrible and prices were low. And by doing that just once, they were set for life. Sometimes not buying is the smartest investment move. If you're not willing to take the time to understand an investment, and you invest in it anyway, then you're going to be left with nothing except a tattoo across your chest that reads, "A friend asked me if there are no trees on Tatooine, where does the oxygen come from?" I said, "The same place it comes from, on Jakku." Number two, if everybody is excited about it, it's probably overpriced. Be fearful when others are greedy, and be greedy when others are fearful. Those words are attributed to the most successful investor of all time, Warren Buffett. That's not Warren Buffett. But when people are excited about an investment and celebrities are promoting it like crazy, that usually means a lot of people are buying it, and that drives up the price. When the price goes up too quickly, that not only means the investment is probably overpriced, it also means that it is ripe for a fall. Two of the hardest things to do in the investment world are to buy on bad news and sell on good news. Most people do the opposite. They buy on good news when everyone is talking about the investment, when it seems that the investment just keeps going up and up. And then when a crash happens, they sell everything. Some great questions for investors to ask are these. What investments are people not talking about? What have people ignored? What's been forgotten? The answers to those questions can be a great place to look for investment bargains. Number three, even if you do understand it, does it make sense? While many people can't explain how cryptocurrency works, most people, for example, can understand the concept of buying a house. It's been done for centuries. But in the mid-2000s, the U.S. banking market began slowly peeling away restrictions on loan qualifications. Eventually, when nearly all of the barriers were removed, we had what was referred to as the Ninja loan. Ninja stands for no income, no job, or assets. A person could literally get a loan to buy a home with no income, with no job, or any assets. A person could literally buy a house that they couldn't afford. Not only that, people were allowed to do that more than once. People had multiple properties that they purchased with Ninja loans. So even though the average person understands the investment of buying a house or a rental property and understands that often you need to get a loan to do it, does it make sense to give multiple loans To someone who doesn't need to prove that they have a job? Someone who doesn't need to prove they can actually make the payments? If it doesn't make sense, it's not worth investing. In the case of FTX, a 30-year-old CEO suddenly was worth billions of dollars. Now that can happen, and I don't judge people because of their young age. I do raise an eyebrow, though, whenever someone makes that much money that quickly. Now again, it does happen. Mark Zuckerberg did it, but Mark Zuckerberg had Sheryl Sandberg to help him. Zuckerberg understood the product, Facebook, but Sandberg understood the business. Her focus was on making Facebook profitable. So there's nothing wrong with a young person making an enormous amount of money, but when they do it that quickly, it is worth taking a closer look. According to FTX's new CEO, John J. Ray III, there was no top-level board of directors at FTX. A board of directors is a diverse group of people in charge of many things, and one of which is the oversight of the company. They're removed from the day-to-day operations, and they offer a step-back viewpoint of the company. But FTX had no such board. No one was watching. And number 4, never put all your eggs in one basket. The bottom line is this. Did I see the collapse of FTX? Well, I have never owned cryptocurrency, and I wasn't watching FTX, but no, I didn't see it coming. I didn't see the collapse of Theranos coming. I didn't see Enron coming. I didn't see WorldCom coming. And neither did the regulators and the really well-paid analysts who are supposed to do nothing but look for these problems. I did see the collapse of the dot-com economy in 2000 and 2001 and the collapse of the mortgage industry in 2007 and 2008, but I didn't get the timing right. I thought both of those disasters would happen earlier than they did. It can be hard to see these things in advance. It can be very hard to detect fraud. What's more, there are many completely legal ways for a company to make itself look more valuable than it is. The only way to truly protect yourself is to diversify. Will there be some fraud? Yes, but it won't all be fraud. I feel horrible that people lost money with FTX, and I feel even worse for the people who lost their life savings. But I have to ask the question, why were your life savings in FTX? Why were your life savings in any one place? Spreading your money over different investments in different markets with different financial institutions will always be good advice. If you enjoyed the show, please consider hitting the like button and subscribing to this channel. And if there is a question that you would like me to answer, please let me know in the comments section below. I'm Peter Billigus, and thanks for watching.